back to the Peterson Institute for International Economics. Thank you for joining us this morning for our virtual event to launch the IMF's Fiscal Monitor report on state-owned enterprises. State-owned enterprises, of course, were becoming even more of an issue pre-COVID pandemic in that they were a source of friction in trade. They were a question about what leads to success. They were a worry about fiscal waste and misallocation, as well as seen as a potential boon for getting to necessary size and scale, particularly in developing countries. Since the pandemic has hit, the interest in state-owned enterprises has become more acute in the sense that the government is getting incredibly involved in all kinds of economies in which enterprises survive the buffeting that is brought on by the pandemic, by the lockdowns, and by people's changes in demand. The IMF, as fiscal department, has done a great deal of work on the issue of state-owned enterprises, and we're proud to once again be hosting them for the presentation of their thematic chapter from the Fiscal Monitor. This year, Paulo Medas, Deputy Division Chief, and John Ralyea, Senior Economist in the IMF Fiscal Affairs Department, will present the report's findings. We're also going to have two discussants. First will be Emilio Pineda, Chief of the Fiscal Management Division at the Inter-American Development Bank. And second will be Mary Lovely, Senior Fellow at the Peterson Institute and Professor at Syracuse University's Maxwell School of Citizenship and Public Affairs. This is an important issue for us all, and I commend the Fiscal Department of the IMF for their role in tracing out just how much wider the state-owned enterprise issue is, both in terms of its implications, but also its sheer scale, than many appreciate. Let me turn it over now to Paulo Medas to begin.
Okay, thank you very much, Adam, and thank you to the Peterson Institute for the opportunity to present our latest analytical chapter of the Fiscal Monitor, especially at these unusual times, and I hope everyone is safe. So as Adam has mentioned, we have decided to take another look at state-owned enterprises and their evolution over the last 2 decades or so. They are in many ways a less known and less understood arm of the government. These are companies that the government owns fully or partially together with private investors. These are companies that have commercial activities, but they also have a very special role in the sense they are mandated by governments to achieve certain policy goals. This could be a water company that has a mandate to deliver water to everyone at affordable prices, an electricity company, or public transportation that affects everyone's life. So they are present in all countries in the world. So maybe, can we still see the presentation? I don't know if...
It will come up shortly. Thank you for your patience.
Okay. So basically, we wanted to look at the two key aspects, I think, of here it goes. Maybe can you move to the next slide? Yeah, perfect. So as already Adam mentioned, there's a growing interest in SOEs over the last, I would say, 2 decades or so. And there's a few aspects that come out, I think, that has created that interest. One is that the growing importance of SOEs in the global markets, in the global economy. And I'll talk a bit more about that later. And the other aspect is the role that SOEs are playing in crisis, but also managing periods of large recessions, not necessarily crisis, and this has been an interesting aspect during the global financial crisis. And now we see also in the pandemic a renewed interest for what some of these state-owned enterprises or especially public banks can do to help governments manage crisis. So, and for that you need these SOEs and these public banks to be well operated and well funded. So these are some of the main motivations. We won't go through the entire report, so you'll have to read it, hopefully you will. But let me give you some of the key messages or themes in the chapter. So as I mentioned, these are the companies that are all over the world, and they are providing basic services. They are trying to promote economic development, and they are present in key sectors of the modern economy. Okay? However, on the other hand, governments are really struggling to get the most out of these companies. Their performance tends to be poor in many countries, and that undermines economic growth. That leads to fiscal costs, because if these companies have losses, then the government has to bail them out. So they are important on one hand, but they are not performing as well as we expected given their important role. So building on the international experience, the report asks a few questions, and I just wanted to highlight two of them. One is, what can governments do to get the most out of these SOEs? And the other is how to promote a level playing field. And this has been a concern both domestically in economies, so if these companies, SOEs, are getting some special treatment, but it's also getting more important given that they are expanding to global markets. So it's becoming a quite relevant question, and we will talk more later in the presentation. So next slide, please. So SOEs come in very diverse ways, and many, and especially in size. You have the very small SOEs with very small number of employees. But here I want to highlight the other side, which is some SOEs have increased significantly. They are now among the largest in the world. And what we show in the chart, for example, the chart in the right, is this expansion of SOEs, especially over the last decade or so, where, for example, in terms of assets, they have reached now around $45 trillion in assets, which represents about 20% of the assets of the 2,000 largest firms in the world. And this has been driven to a large degree by emerging markets, and China especially, which is not surprising because these are the countries that have been growing the fastest. So that partly reflects their increased economic importance. Another interesting aspect we've seen in the slide in the left is that as they also grow their size of their operations, they also become more active in debt markets. And this was not something you would see in the past 20, 30 years ago. SOEs would not usually go to debt markets on their own to depend on governments, but now they are going, and they are becoming very big players in debt markets. Okay. So next slide, please. So they are diverse not just on size, but they are also diverse on the sectors they operate. I mean, we find SOEs for government ownership in firms like hairdressers, hotels, ski resorts, factories. But where they are most prevalent actually are in key network sectors of the economy. And the slide shows, for example, some of them are quite these giant companies like the national oil companies. And you can see in the chart, the largest national oil companies account for about half of the oil and gas production in the world. They are also very present in the financial sector. For example, in emerging markets, public banks have a very large share of the market, but this is also in some advanced market economies like Germany and also low-income countries. So they also play a big role. They're also very present in other key network sectors of the economy, like electricity companies, water companies. So they're really important for the normal functioning of economies today. And whether they are efficient or not is going to have an impact on the entire economy. So next, please. Next slide, please. Okay. So the other aspect I've been hinting, which is, I think it's quite interesting and poses new challenges, is the growing role of SOEs in the world. And we are seeing multinational SOEs. Where some of them operate regionally, some of them operate globally. These are also companies that have very complex hybrid governance structures. Sometimes it's even difficult to ascertain fully what is the level of control of the state, what is the level of control of private investors. So these are very complex companies. For example, in Europe, you have almost 600 multinational SOEs. And this has, as and Adam also mentioned before, this has created some concerns. So why are these SOEs expanding? Are they just trying to maximize profits? Do they have other political goals, for example? Are they competing in a level playing field, or are they getting support by governments and having unfair competition? So these are some of the issues that are coming up as they become more prominent in global markets. So next slide, please.
1 minute, Paulo.
Sure. So we can move to the next slide. All right, thank you. So yeah, thank you. So a quick question then we want to look was what is the performance of these SOEs and what is driving them? And as I mentioned before, we looked at the performance of SOEs versus private firms. We had a sample of about 1 million firms in more than 100 countries. And let me summarize some of the key results. One is that we find that on average, systematically, private firms outperform SOEs, state-owned enterprises. But this differs, for example, it differs across sectors. So if you look at the sectors where there's more competition, where more tradable goods like manufacturing, retail, then private firms are much more competitive, much more profitable, much more productivity than SOEs. If you look at sectors that are more regulated, the difference is not as large. Another aspect we investigate is whether the degree of ownership of the government makes a difference, and we do find, and the chart in the left shows that we do find some difference. So if companies where government has a majority tend to perform the worst, when it has a minority, they tend to perform somewhat better, but it's still a big lag compared to private firms, where they tend to be much more profitable, much more competitive, much more efficient. We looked at different measures of performance. Another aspect we look, which is in the right, is we try to see what are the drivers. One key driver that came up is the degree of governance or corruption in a country. So countries where governance is very high or corruption is very low, SOEs perform much better than SOEs in countries with high corruption. Also, what we thought was very interesting is that the gap of performance between an SOE and a private firm also changes dramatically. So in highly corrupt countries, the performance of private firms, the productivity is 3 times as large as an SOE. But that gap is much smaller in countries with high governance. So when you have governments with a very low corruption, very high governance, they are able to get more out of their SOEs. So just before passing to my colleagues, if you can go to the next slide.
I think you're running out of time, Paulo, so do this slide quickly or give it to John.
Sure, I'll just very quick. This is just to illustrate one point on public banks. We are using here the example of Brazil, just to show one point that public banks actually, one of the key questions was to ask if public banks can help countries manage periods of recessions or crisis. And what we find some evidence, especially in emerging markets, that public banks do tend to help. They are less pro-cyclical or more counter-cyclical, but that depends on the degree of debt of government. So they need to be funded by governments. So that constrains their ability. So I'll skip this slide and pass it on to John. Thank you.
Thank you, Paulo. Not surprisingly, given the diversity, complexity, global presence of SOEs and the relationship with the government, SOEs bring challenges and risks. Next slide, please. To draw this out a little bit, we take a look at SOEs in the network sectors. The network sectors themselves tend to be natural monopolies and critical to the functioning of economies. This, in and of itself, suggests that there may be a role for state intervention in these sectors, which can take the place through a regulation of private firms or the introduction of state-owned enterprises. Many countries have tried to introduce private firms, but this is proved challenging. For example, in advanced economies, there's numerous examples of trying to bring private firms into the water sector and then having to essentially renationalize the firms. That leaves most of the water sector in advanced economies actually being run by state-owned enterprises or other government entities. In the case of emerging markets and developing countries, we see SOEs are quite prevalent across all three network sectors that are the power, water, and transportation. This has resulted in some challenges, and SOEs tend to struggle a little bit. For example, if you look at the chart on the right, we see that SOEs in some countries can run their own deficits that are equivalent to 3% of the GDP of their fiscal authorities. And the result of this is that SOEs underperformance leads to difficulties in extending the network to reach citizens in their countries, which leaves billions of people without water in some countries, as well as hundreds of millions without electricity. Next slide, please. So the question is, why are SOEs struggling? Well, there's a number of reasons. One is simply that their owners, the government, fail to provide clear mandates to the SOEs. Should an SOE focus the majority of its resources on delivering on the policy mandate or the public good that they've been asked to do, or should they concentrate more on being profitable and self-sufficient entities? SOE managers know that government officials would rather bail them out for poor performance than close them down and destroy the jobs that the SOE provides. Also, institutions in many countries that have SOEs are underdeveloped, so the capacity for effective oversight that government as owner should carry out is not present. One particular one particular issue that is particularly present for SOEs is unfunded mandates. This is essentially the SOE provides a public service, such as providing below-cost electricity prices or gas service to clients, but the government does not then reimburse the SOE for the service that it provides at below cost. As a result, SOEs can tend to borrow or resort to borrowing, and this can lead to a buildup of SOE debts. And the chart on the right shows that in some cases, SOE debts can exceed the debts of the general government. With this, of course, can rebound back to the general government in the form of a need for support for the SOE. And over the last 20 years, we've seen instances where the government has had to bail out SOEs to the tune of a cost of 10% of GDP or more. Next slide, please. So this raises the question, clearly SOEs have a role, but we need to get the most out of them. Next slide, please. The question is, how best to do that? Well, for a start, governments and SOEs need to prioritize using government resources efficiently. After all, these are the taxpayers' money for which they are responsible. One way to do this, in the case of state-owned enterprises, is for the government to review the rationale for the existence of SOEs on a fairly regular basis. Germany does this every 2 years to try to weed out those SOEs for which the rationale no longer supports their existence. Also, in the case of SOEs that are in competitive markets and where the private sector provides the good or service just as efficiently, there's a case for governments to consider privatizing the SOE. Now, privatization, however, to be successful requires a number of preconditions. First and foremost, you want to have independent and competent regulatory authority before considering the privatization. Also, a strong rule of law and respect for property rights. And generally, privatizations, it's been shown in the literature, tend to be better or in environments where there's a lower level of corruption across the institutions. Of course, SOEs are also part of the broader public sector, and therefore, it makes sense for SOE performance to be included in public fiscal targets. This, for example, including the debt of SOEs and the overall debt stock that a government reports. This will better help align or force policymakers to fully consider the implications of delivering mandates to SOEs and the costs associated with that in the broader public sector fiscal space. Of course, we also want to make sure that the incentives are structured correctly for SOE managers to perform. One of the key areas here is getting pricing policies correct, by at least at the cost recovery level, to ensure sustainable business models for the SOE. And another critical area would be the quality of institutions. Effective oversight being one of the most important. And a recent book by the Inter-American Development Bank on SOEs that was co-authored by one of our discussants, Emilio Pineda, emphasizes this point. At the risk of oversimplifying, one of the things that countries can do to improve oversight is to establish a unit that effectively gathers, monitors, and reports on SOE financial performance. Location of this unit in the Ministry of Finance would make sense. And finally, on this note, transparency is highly relevant. These reforms do have benefits. As the chart on the right shows, using a novel database of data from IMF programs from 2002 to 2017, we reviewed the impact of reforms on state-owned enterprise performance. And what came out, most noticeably, what came out of this is that reforms to improve governance or pricing, the green or blue bars in the chart, have a definitive and significant impact on the productivity of SOEs. Next chart, please.
I'm sorry, John, go back a slide, please.
Yes.
I'm sorry to interrupt, but just a clarification. I find it confusing in your chart on the right that the red bars, which mean all reforms, are less than either the pricing or the governance reforms. So is that the other reforms are counterproductive, or all reforms doesn't include pricing? How do you end up with that result?
Yeah, so with respect to the red bars, some of this reflects the fact that one of the key reforms is also the clearance of arrears that we ask SOEs to do, which has broader benefits for the economy than just improving the productivity of the SOE. So it certainly helps facilitate flows of finance through the financial system. You pay your suppliers, who then can pay their workers. That doesn't necessarily show up as a productivity gain for an SOE, although it carries greater benefits for the economy. That's one of the reasons, yes. Next slide, please. Okay, so in terms of governments, one thing that needs government support for SOEs, we've indicated that the SOEs face mandates, and it's important for governments to help finance those mandates. It's just part of general good fiscal governance. If a fiscal or a public policy activity is being carried out, it should generally be reflected, or it should be reflected in the government's budget. So governments tend to provide support to SOEs on the mandates. However, in reality, sometimes the support can result in what we call preferential treatment for SOEs that may lead to market distortions. As an example, the chart on the right here shows that we looked at the borrowing costs for SOEs relative to private firms, and the blue and red bars show that for private firms, they incur a higher borrowing cost relative to SOEs. Now, one may ask why this exists. It's possible it exists due to the implicit or explicit guarantees provided by the sovereign. In other words, lenders to SOEs assume that the sovereign may bail out the SOE should it run into trouble and not be able to pay its debts, hence the lower borrowing costs for SOEs. There have been, so this competition and the distortion thereof, it takes place both domestically and globally, as Paulo indicated earlier in the presentation. And there have been some efforts to try to address this, whether it's through the WTO and subsidies or various regional trade agreements, or even the EU in terms of the state aid regulations that is put in place for its countries and the companies therein. However, the issue remains unresolved. Next slide, please.
John, we're going to need you to wrap up and probably just get through this slide very fast.
Yeah, so SOEs can play a very positive role in trying to achieve global goals. One is they are, in many cases, key producers of power in countries. And to the extent that they rely on fossil fuels, that this can be changed to rely on less polluting revenue fuel. The SOEs can certainly help improve with climate change. On the issue of competitive neutrality, which is leveling the playing field, we propose to principles, multilateral principles that could help bring all the various parties, all the various countries to the table that are concerned about competitive distortions in the global and domestic environments to consider what are some principles that could guide SOE actions in the marketplace. Final slide, please. However, I just want to highlight very quickly that this, of course, is easier said than done. And one key area that would need to be addressed is the level of support and measuring the level of support, both implicit and explicit, that governments provide to SOEs. This chart identifies some of the key concepts and questions that would need to be reviewed, discussed. For example, as simple as how do you allocate the costs of an SOE between activities that undertakes for commercial purposes and activities that undertakes to fulfill its mandates.
Great.
With this, I conclude the presentation.
Yes, thank you very much, John. That was great. I'd now like to turn to Emilio Pineda of the Inter-American Development Bank to give his remarks on the topic and on the report. Emilio, please.
Thank you very much, Adam and Paulo, for the invitation to comment on this very relevant chapter of the Fiscal Monitor. Good morning to everybody. I think this is it's very good news that the IMF and FAD are putting renewed focus on SOEs and their economic and fiscal impact. Overall, I find this chapter insightful, and I think it is particularly important that the report puts back fiscal issues such as sub-budget constraints or fiscal extraction issues at the center of the discussion of SOEs performance. For too long, reform of SOEs has been mostly limited to issues of corporate governance, which are relevant but clearly insufficient. So what I will do, I will first summarize some of the key findings and conclusions and recommendations of the report, and then I'll provide some specific comments. There are three key messages from the report that I would like to emphasize. First, that we must pay close attention to SOEs because they're extremely relevant. SOEs, as Paolo already mentioned, they have very large economic and fiscal impacts. They operate in virtually every country in the world. Most countries have hundreds, if not thousands, of SOEs, and they're dominant players in crucial sectors of all economies. Furthermore, SOEs receive constant government budgetary support they offer examples of countries that, for instance, spend 2 percentage points of GDP per year supporting these SOEs, and represent a very significant contingent liability that have required bailouts of up to 16% of GDP. So they're very significant economically, and they have a very significant fiscal impact. So we must pay very close attention to them. And that's, I think, a crucial first message. Second, they offer very, very convincing
Have we lost the sound? Or is it just me? Emilio, I fear. Emilio? I'm sorry. Jessica, could you please turn to Mary since Emilio, or are you back, Emilio?
Can you hear me now?
Yes.
When did I go out? So I'll go try from the beginning, Adam, if you don't mind.
Skip the 2 first paragraphs about this is a good study and you're glad the IMF has done this, and go to the paragraph following that, please.
Okay. So what I'll do is I'll first summarize some of the main conclusions and recommendations of the report.
Perfect. Thank you.
And then I'll give some comments. So the first conclusion of the report is that we must pay very close attention to SOEs. They have very significant economic and fiscal impacts. They operate virtually in every country in the world. Most countries have hundreds, if not thousands of SOEs, and they're dominant players in crucial sectors of all economies. And they also have very significant fiscal impacts. SOEs receive constant government budgetary support. The report offers examples of countries that, for instance, spend around 2 percentage points of GDP a year supporting these SOEs, and represent a very significant contingent liability requiring bailouts of up to 16% of GDP. So they are very relevant, and we must pay very close attention to them. A second main finding and conclusion is that SOEs are frequently inefficient. The report offers different measures of firm productivity, such as return on equity or labor productivity, showing a significant gap with private sector's peers. These findings are fully consistent with a long literature showing this type of underperformances. And at the source of these inefficiencies, we have 2 sets of issues. The first one, which I call fiscal governance issues, are related to how the central government transfers resources to the SOEs and how the central government extracts resources from SOEs. On the one hand, SOEs do not have incentives to be efficient, because if they run into financial trouble, they know they will be bailed out by the central government. The markets knows it as well. So everybody knows that since SOEs cannot go bankrupt, it is rational for SOEs to be inefficient. On the other hand, even if SOEs were to run a profit, they run the significant risk that the central government will extract all of its profits, either through extraordinary dividends or by forcing them to sell their products below market prices or to carry unfunded mandates. This is which I would call a fiscal extraction problem. So these fiscal governance issues make it clear that it's no surprise that most of SOEs are not efficient. On the contrary, given these issues, it will be surprising that they will be efficient. The second set of issues are issues more of a principal agent nature, which are monitor and oversight. In many countries, governments, agencies do not have sufficient information or capacity to properly monitor SOEs. So what to do? The report offers, I would say, 3 main sets of recommendations. First, to collect data on SOEs. That's the crucial building block for any policy reform effort. That's crucial and urgent in a lot of countries across the world. Second, to address the issues of the fiscal governance, there are a set of reforms. First, we need to get the price right. We need to ensure that the SOEs can charge the cost recovery. And also, very importantly, we need to set limits on SOE borrowing by including them in the fiscal targets. And then to address the issues of monitoring and oversight, it's recommended to use a centralized model of strong oversight to control agency so they can yield better performance from SOEs. I largely agree with the report findings and recommendations, but I have three main caveats. One on the data, one on the use of the fiscal rules to set borrowing limits, and one on the use of centralized monitoring agencies. So first on the data. Lack of data is a crucial problem, and I think international organizations could play a more proactive role to solve it. So even if collecting this data should be the primary responsibility of national governments, international organizations, and especially the IMF with its leading role, I think could play and should play a more proactive role in promoting the collection of this data by requesting it through its surveillance instruments like the Article 4. Unless this happens, I think the lack of data across countries is going to remain the status quo. My second comment is on making use of fiscal rules to set borrowing limits for SOEs. I fully agree with the need of setting limits to SOEs borrowing, but one needs to be careful on how these rules are designed and implemented. Fiscal rules requiring SOEs to consistently run balanced budgets put them at a competitive disadvantage relative to other firms in the same sector and can lead to serious underinvestment in the development of public services. For example, in the case of Peru, where SOEs are included in the fiscal targets of the general government, and are subject to the same reviews for their public investment projects as any other ministry, the rate of implementation of SOEs planned investment has been very low in crucial sectors such as electricity. This is a reflection of financial constraints. The SOEs largely because of the fiscal rules cannot borrow, and the cumbersome procedures to vet public investment proposals under the national public investment system. So there is a trade-off between mitigating the fiscal risk and how efficiently can the SOEs perform. Redefining the main fiscal targets in terms of the general government instead of the non-financial public sector and introduce specific rules to the SOEs related to each enterprise capacity to service debt may be a more nuanced approach that would allow SOEs more space to carry necessary investments. At the same time, it would still mitigate the fiscal risk. And my third and final comment is on the centralized agencies and holdings. While these agencies and holdings are a very good solution for small and medium-sized firms, they might not be the best solution for large strategic SOEs. For example, in the case of Latin America, large SOEs like Codelco in Chile, Pemex in Mexico, Petroperú in Peru, for those cases, given their political clout and how complex these firms are, governments need a combination of administrative controls with market monitoring to improve their functioning. The technical complexity of these firms is significant, so it's very important that the market monitoring complements the government. So in these cases, our evidence shows that there is a very strong case for at least partial privatization of these large firms so that the supervision and surveillance of these firms is enhanced by thousands of market participants. So with this, I conclude. I think this is a very sound, a very interesting report. I'm very happy the IMF is putting back its focus on this again, but I think there are still elaborations and more policy discussion on nuances that we need to carry forward to enhance the policy recommendations. Thank you very much.
Thank you very much, Emilio. Now let me turn to my colleague from Peterson, Mary Lovely, to give the final discussion before we go to group chat. Mary, please.
That wasn't a problem given the spring we've been having. That wasn't a problem that I anticipated. So first of all, I'd like to congratulate John and Emilio and Paulo on the report. It's obviously extremely timely, and they make a very convincing case about the importance of SOEs and SOE reforms. I think for many people reading the report, the size of SOEs, the extent of their geographic coverage and their sectoral coverage will reinforce the belief that SOE reforms are necessary. Emilio went over the what I think of as the fiscal reform part of the report. I'm going to focus on a narrow section of the report, a smaller section of the report, which is about the SOEs being good global citizens. And in particular, I'm going to focus on the idea of competitive neutrality. So let me move to full screen here, and hopefully you can see my slides. Okay, so we have established that SOEs are big players, not just on the domestic stage, but also on the international stage. Not only do they operate in every country, they're prevalent in some sectors with very large network externalities, not just domestically, but increasingly globally. Public banks are extremely important, as are firms in a variety of industrial and even service sectors. The SOE share of the largest 2,000 firm assets is 20%, so it's 1/5 of these enormous multinationals. They are deceptive in ownership structures sometimes. Many have a mix of public and private ownerships. It's not just a simple, we own 50%. It's also complex ownership structures involving holding companies and other types of structures that make it difficult for us to see through the veil to the true level of state ownership and control. The report mentions a finding that there are over 1,500 state-owned multinational firms operating. I think we have to be honest in saying that one country is driving the growing concern about the global citizenship of state-owned enterprises, and that is China. I found this graph particularly informative. If we look over the last almost 2 decades, you can see that it's that increasing red area, which is China, that is driving the overall upward trend. And that, of course, leads to a host of other issues having to do with China's, not only its political and economic system, but also its growing role in the private sector. And these concerns become very important as other countries seek to promote reform of SOEs. The fiscal monitor recommendations, which Emilio has covered in detail, are here. I will just briefly say that they are focused to a large extent on making the mandate of the state-owned enterprise transparent, and then using that mandate as a springboard for raising performance, particularly by linking support specifically to the mandate, deciding how much the SOE needs to be subsidized to meet this mandate. For example, provision of clean water to rural households. There's a need to align fiscal incentives to meet this mandate, and also to enhance oversight and governance performance, which would be related to the effective and efficient achievement of the mandate. Now, what we see here is that the fiscal reforms constrain, but they don't end subsidies. In other words, these subsidies are, SOEs are a conduit for subsidies, and that these clearly would affect the competitive position of other firms, not only in their home market, as was discussed by Paulo, but also in other markets, markets to which they may export if they are a multinational, and to third markets where they compete with private sector firms or even SOEs from other countries. Best fiscal practices do not stop these competitive effects unless they are particularly limited in the types of subsidies that are offered. Because these fiscal practices have not been effective in stopping these competitive effects or spillover effects to date, SOE reform and subsidy reform often overlap in public discussions. So SOE reforms invoke then a search for quote unquote competitive neutrality, which is an ideal of an undistorted market competition, some set of prices which can be used to constrain subsidies to the SOE and to ensure that companies that are competing with the SOE have a quote unquote level playing field. So my question really is, what have we done with this idea of competitive neutrality? I think it's well known already that existing WTO subsidy rules are limited. One of the key, sorry, word I'm looking for here. One of the key goals of the WTO process is to have notification of subsidies. But we all know that countries are extremely slow in notifying the WTO of subsidies. And in fact, by some counts, China is at least 10 years behind in notification. Without notifications, makes challenges by other countries of these subsidies very difficult. But we also know that transparency is only the tip of the iceberg. Even if we had transparency on direct subsidies, we would know that many supports are implicit or indirect. That is, they're through other types of entities or through holding companies, which would make it difficult to truly measure how much the competitive environment is affected by SOEs. As a result, damages occur before challenges are adjudicated. This leads to enormous frustration among other countries, and oftentimes remedies, if they are achieved, they have no teeth. Now, recent trilateral statement issued by Japan, signed by representatives of Japan, United States, and European Union, seek to push this type of reform harder. Basically, the trilateral statement that was issued in January of 2020 drills down harder on the idea of achieving competitive neutrality. Here's a list of the things that are in that statement. They include identifying new unconditionally prohibited subsidies, and expanding the definition of public bodies to include SOEs. So they're basically trying to push rules that would add some teeth to this idea of identifying subsidies that alter the competitive landscape, and then making sure that countries that pursue those policies in some way pay a price for doing so. My question really is whether this is sufficient. Are we trying to discipline countries achieving their mandates, or is it that the mandates are incompatible with competitive neutrality? Here I look at, when we have large economies of scale, subsidies may increase global surplus, but not produce mutual gains. A good example might be a government today who's seeking to subsidize creation of a vaccine. We may say that there's a limited public health role there, but we all know there's also a gigantic amount of rents that could be earned. So it may be that the domestic welfare maximizing approach would require disrupting the market equilibrium, but it's exactly those current day prices that we're going to use to try to establish competitive neutrality. And in this case, I think trying to achieve competitive neutrality is asking the SOE not to achieve its mandate, or for that matter, subsidies that are issued by the government through the private sector. So we really go back to what the government is trying to achieve. This includes, I think, many of the activities that we see today, not only in China, but throughout the world, India, for example, and in parts of the European Union. Some examples might be industries where we have large fixed assets and high cyclicality, such as steel, which we have seen perennially be unable to solve this issue. Large fixed assets, high rents, such as on internet platforms or other types of new economy, plumbing. And lastly, large fixed assets and spillovers, such as semiconductors. I think these problems are heightened when we add national security concerns, but they aren't fundamentally only national security concerns. So I think fiscal reforms are clearly needed, especially for the large number of SOEs who really are not players on the global economy, but provide essential services. I think the report and Emilio and his discussion have made clear how important that is, but I would also argue that it's not enough. Fiscal reforms of this type may simply make companies more effective at meeting their public mandates, but some mandates will have effects outside national borders. That may not be a bug, that may in fact be a feature. And reforms that help countries achieve these mandates may increase, not reduce conflict. Competitive neutrality cannot fully resolve the types of conflicts that we're seeing in the global economy. I think we need new thinking about how these sectors that have large economies of scale and global rents will be shared and how new entrants will be accommodated. Thank you very much, and I look forward to the discussion.
My timer was going off and I didn't want to take mute off until the timer went. You were perfectly on time. More importantly, Mary, I think your summary of this particular aspect of the SOE question and this question of, are we looking to restrict their mandates, or is it the mandates themselves that are a problem, I think is fascinating, and I'm hopeful for a PIIE publication on that theme. So let me now go back to Paulo and John. If either of you want to make a brief response to anything that Emilio or Mary raised, and then I will start transmitting some of the questions that have come in over the Q&A function. So first, John or Paulo, anything you would like to add?
Maybe just briefly, thank you for the comments. I mean, I basically agree with everything. I think some of the issues we touched are very complex, and obviously this is a relatively short report, so we can't cover it in detail, but it's something we keep working. And I think, for example, Emilio touched on the issues of whether the state-owned enterprise should be under fiscal targets, fiscal rules, and how do you monitor. I think this is an area that countries debating and trying to find the best way. But our main objective here is try to create the right incentives. You want, first of all, you want SOEs to be at the minimum reflected in the public finances so that everyone can see their size, can see their impact, can see their performance. I think that's absolutely critical, and they should be in the what we call fiscal statistics or financial statements of government. So they have to be included. In many countries they aren't. We don't even know how many SOEs they have, and are they efficient, and do they have large losses? So that's one aspect. I think bringing that to the fiscal accounts and bringing it under the fiscal targets can create a tremendous incentive structure to be more transparent, to be more efficient. In terms of the competitive neutrality, and I absolutely agree with Mary, I think these are very complex issues. Again, we wanted to touch it primarily from the fiscal side because obviously this is the fiscal monitor, but we do think that the fiscal plays a key role. But these are really complex issues, and I think at least our proposal is that we need more global cooperation. We need countries to sit at the table, at the same table, and discuss. I think there are concerns both from the countries that own the SOEs and the countries that host the SOEs, or the countries that have to compete with the SOEs. And I think it's important countries sit down at the table and think about these issues. And I agree there may be debates in the questions. In some cases, transparency and trying to identify the costs of the mandate so that at least that is very clear, and the company doesn't get other types of subsidies beyond the mandates may be enough. In other cases, may not be enough because there may be some tensions on whether the mandates are appropriate or are they themselves creating distortions in markets. But we at least we think would be a good first step to bring a more cooperative game, let's say, among countries to try to understand all the issues and try to find some set of guidelines that could help. And I'll stop here.
John, do you want to add anything, or?
I think Paulo covered the ground very nicely. I just very thankful for the comments provided by the two discussants. Thanks.
Great. If I could just make a couple observations, because also some of the questions that came in were very factual. So I think that one of the things to look at is the whole report. And we have the link to it on the PIIE website, along with what will be permanently the video of this discussion. And of course, the full fiscal monitor is available for download directly from the International Monetary Fund website. So I encourage everybody to look at the full report. there were a couple things that I think I don't recall being in the full report, and forgive me if they were wrong, but that I think would be interesting to raise. I mean, one is, you have that chart of the circles of how many multinational SOEs there are by region, a little bit more about the discussion of what's the history of why certain regions are so much more than others. There looks, as Vikram Nehru raised on the Q&A, it looks like a weird number a bit for South Asia, because we're very aware of a lot of large entities in India, for example. Again, I'm sure you did all the best with the data you could, but just I would have liked to have, and I think it would be great if you made available to people a bit more of the descriptive sort of atlas of the world in this space. And similarly, you broke out, Paulo, in his initial slides, broke out, the network firms and the oil companies, the banks, the power generators. And again, it would be interesting to have a bit more of a breakdown of, are these different in nature from say, state-owned enterprises in steel or airlines, where there may not be as much of a natural monopoly case. Now, again, you may have some of this data, or it may be just you haven't presented it yet, but as a consumer of your work and someone interested, I think these kinds of descriptive statistics would be useful. And third, moving slightly more analytically, I think it is you discussed various reasons why the countries have state-owned enterprises, and that might be positive, and in particular with even though I forced Paulo to rush through it, the memorable chart of the NDS doing a huge amount of counter-cyclical lending in the global financial crisis, for example. But one thing you didn't mention is that a long historic idea behind these kinds of SOEs, at least in some countries, was a developmental motivation, that over time this would give them an industry or a national champion even in a particular sector. And again, that's not what you were focused on, but some sense of how much that motivation has paid off through the years. Are there examples of countries that did put their money into a national SOE and get something out of it? And of course, that relates to some of the things Mary raised in a sense about what China had in mind. Those are just some suggestions for things that might be of interest to a broader audience to go with your very sound report. We had another question, comment from Vikram Nehru over the Q&A. The findings and conclusions of the report appear to reconfirm what is already known about SOEs. Can the authors comment on what findings they consider to be new, surprising, or counterintuitive? I wouldn't have put it quite that way, but I do think it's fair to say that a lot of what you said is very sensible and important, and it's good to have confirmation of what's sensible and important. But in this research, was there anything that surprised you, John or Paulo?
So let me start, and maybe John can complement. Thank you for your suggestions. We have been trying to collect, I think, data, the point you made, and Emilio also. I think data regarding SOEs is really a tremendous challenge.
Yeah, but hold on a second. If you put up data and say you've got a data set of 1,000 SOEs and you're able to code them by industry, then you can already respond to some of my questions. So right. Don't just revert to saying data's tough.
No, that was my second part. I think we can continue to do more work to improve our data set, but obviously it will be available, all the data set that we collected to the public, so people can look at. One thing on the sectors we do find is that the network sectors, that's where you see a more prevalence of SOEs across all countries. So it's common, so they are there in public utilities, public transportation. In the other sectors like manufacturing, real estate, they are much less presence and varies tremendous across countries. So that's something we found. On the development strategy of public banks, yeah, we have some discussion in the report. And this is an area that there's been a lot of work done, and most evidence, yes, is that public banks have struggled with development objectives. So they have not been very effective. There are some examples where they've been able to promote more growth, for example, of small and medium enterprises, but they have been plagued with many problems on governance, on efficiency. So that's another, it's common not to many SOEs, many sectors, but also public banks in this respect. So that's one concern we raised. Even when you use public banks, not just for development, but for example, for helping manage the cycle, there is a concern with the governance and the quality of the credit and making sure that it's appropriately done and not through loss to corruption or other mismanagement. So that's a serious concern that we observe. I think on the data, maybe a few things. I think what we have seen many studies, but they were focused on specific countries or sectors, and not like we try to do at the global. So we have been able to show this systematic underperformance of SOEs in general across many countries. So I think I haven't seen a country that study that's done to such a large number of countries. And I think we also dig a bit deeper in terms of the differences between sectors. I think the performance varies significantly, and also trying to understand a bit more the drivers. So there's been some debate in the literature whether, for example, is it the ownership that matters, or is it the market structure where the company operates? So some people argue it's not necessary whether you are owned by the government, it's because you are SOEs tend to operate in a highly regulated sector, and that undermines their ability to be efficient and profitable. So I think we show that, yes, for example, the market structure matters, but the ownership also matters. And there's a significant gap, even after controlling for many factors. There's a significant gap between the performance of private firms and SOEs. And we find that some of these factors, and governance comes out a very strong one. And the other is, for example, the ability of setting the right prices for the SOE, the independence to set price. So those are important factors that we find. I don't know if John wants to.
Yeah, John, anything you want to add?
Yeah, just 2 points. Obviously, the fiscal monitor gives a platform for the IMF to raise the SOE issue in a comprehensive fashion, and perhaps bring the issue to a different audience that may normally not deal with SOE issues, and to highlight the importance of these issues. Granted, in a large subset of academic area and institutions, SOEs get a lot of priority and a lot of focus. But the fiscal monitor pulls the issues together in one place and presents kind of a summary of what's going on in the SOE sector, as along with some analysis that Paulo highlighted. The second point I would like to make is just that on the research angle, we did have the benefit of constructing a new database that looks at SOE performance under IMF programs, right? So it kind of gives us a little bit of a controlled environment to see how various reforms proposed for SOEs actually did impact on SOE performance. This is a little bit different angle on the idea that SOEs are just have poor productivity.
Okay, thank you. We've gotten a few questions about China as the elephant in the SOE room along two lines, but neither of them are strictly SOE in a sense. First is whether or not the Article 4's comments on SOE reform in China, which are very limited, match up with what you would generally recommend. And while I'm not trying to get John and Paulo or anybody in the fiscal department in trouble, some amount of reflection on how your principles would apply to China would be interesting. And second, there is the question, and I don't know if Emilio or Mary also wants to come in on this, is the question of how much are China's SOEs being a conduit for loans to the developing world through BRI and other means? And again, that's not your department per se, but is that something that you find common among SOEs, that they are used as conduits for loans elsewhere, or is that a rare thing? Some comment on that, please.
So I'll pass these questions to John, since he works with the China team and is very aware of China issues.
Right. So, John.
Certainly when it comes to the issue of SOEs in China, of course, the team is well aware of the issues, and the various Article 4s over the course of time have pointed to the extent to which SOEs are present in the Chinese economy, and the idea that we encourage basically the competitive neutrality, the level playing field concept within China for its own domestic benefit, and to allow the private sector to flourish in the Chinese economy. In terms of the issue with respect to the global, again, we're kind of proposing a principles-based approach, which would bring the ideas to bring everybody to the table here to discuss how SOEs should basically operate in the international environment. This is at early stages. Basically, the fiscal monitor itself is just putting the idea out there to see what kind of traction it may get. So proposing something like that within the context of an Article 4 or something would be a little premature at this time.
Okay, thank you. We have a question come in from Stephanie Siegel, and this is a question I hope all of our panelists will want to respond to. Could you provide more detailed context from the IMF authors behind the proposal for multilateral principles to limit global distortions and level the playing field, close quote? Who would do this work, under what mandate? Would the principles link to the WTO disciplines, or would it be something else? Would it be GF, G20, IMFC? How do you see this progressing? And again, I'd be happy to have Mary or Emilio's views on this as well.
Thank you. So we are launching the idea. We think, again, because of these are quite complex issues that affect many countries, we think it's better to have a cooperative solution. Which institution will actually take the lead? It would have to be something countries will need to decide. I mean, there are several international institutions that have been involved in some of these issues. The WTO is one of them. The OECD has also done a lot of work on trying to understand this and measure competitive advantage, so they also can participate. We obviously can also give our inputs. But I think this is something countries will have to talk and decide how much they want to advance. There are some examples of the past where, for example, the sovereign wealth funds, where there was an effort by countries around the world to sit together, and where the IMF and other international institutions participated, and where countries came up with a set of principles for the sovereign wealth funds. So that's one example out there that could be followed. But of course, SOEs involve much more set of complex issues that we need to think through. And we would need to think, potential could be the WTO, but it could be other institutions working together.
Okay, I don't know if Mary or Emilio, you want to say something about this? Yes, Mary.
Yeah, I mean, I think this is a great question. I think the world is struggling with these issues. There's no right answer at this point. We're going to try to grow towards some type of accommodation. I mentioned the failure of the WTO to discipline subsidies through SOEs in a way that is satisfactory to a large number of its members, and that frustration being reflected in January's Trilateral agreement. My thinking on this is that, you know, the same old just isn't going to work. Talking about competitive neutrality acts as though developing countries aren't savvy enough to figure out what's in their own best interest. Now, we can say there's a lot of political economy reasons and a lot of government failure reasons why we see the situation. And I think that those two factors cover a lot of the ground. But I think there's a third reason, which is that it's not in their own best interests to not try to grab some of the global rents that can be achieved in economies in industries that can operate at large scale. To that end, I think the IMF can be particularly helpful pushing further with this data that they're making available. As Adam said, trying to illuminate particularly which industries, which questions do we need to rethink and begin to acknowledge that competitive neutrality is not going to be the only solution to this. We're going to have to find some way to share or to divide. And that's what we're coming down to now, where we'll see countries being pushed into one axis or one half of a splintered global economy. So I think this new thinking can be really assisted by the IMF's data, but it's clear that the time has come.
Great. Emilio, do you want to add anything to that, or?
Just briefly, I would like to add that there's growing evidence that at least in Latin America, Chinese SOEs are having an increasingly relevant participation that go from the selling of manufacturing products, such as scanners for customs or investment in infrastructure in large projects. And I think the common theme that have characterized all these interventions is a lack of transparency that I think speaks to the concerns that Mary just mentioned. No? That there's huge concerns that there are implicit subsidies in these participations, and that also there is no clear monitoring of all these agreements between the SOEs and the national government. So this is definitely, I would say, a growing issue in the region, but we don't have enough data or transparency to have a clear dimension of what's going on.
Great. Our final question, Ted Truman wrote a question that I'm going to slightly rephrase. It sort of is a different cut at what Mary was just talking about. How much are we worried about natural monopolies versus not natural monopolies in terms of what's fair and unfair? I mean, should there be, and I mean, is this a useful concept in dividing line for what policy approach or what recommendations you make? Paulo or John?
I guess if I understand correctly, means that you may be putting some types of regulation restrictions to create a natural monopoly that doesn't necessarily exist.
It's more, are we, in terms of competitive neutrality, as we try to figure out where to draw the line and where it's applicable, is this a useful place to draw the line, if I understand Ted's question correctly?
I mean, it's a difficult question. I think we have to understand that fully the policy objectives of countries, and I think sometimes SOEs don't necessarily have to operate only natural monopolies. There may be other reasons why countries may want the SOE there. I think the point is that that I wanted to mention, even on this competitive neutrality, is that this is not just a question on the global, it's even domestically. Countries would want to have solutions that are promote growth and efficiency. So you want to have, if you decide to have an SOE in a certain sector, where you also have competitive private firms, do you really want to create an advantage to that SOE that is going to lead to misallocation of resources? So it's the advantage of the country itself of thinking through these issues and thinking, is this the best use of government support to a company that, and you need to have a strong policy mandate case to justify it, because otherwise, even from the fiscal angle, it doesn't make sense to be using these resources. When you go to the global aspect, I think it adds to this. And the problem is, and I think Mary was hinting at this before, is that you may also have impacts of what may be the decision of a policy decision of a country may benefit that country, but may not benefit other countries, or may not benefit the global. That's where we think the cooperative solution is better, because you sit down at the table and you think about the consequences. Because the alternative is that you're going to have growing pressures for protectionism, for regulatory measures against these SOEs, and it ends up being badly for everyone in terms of economic growth and efficiency. So I think there are if we can find a cooperative way to avoid these retaliatory measures, and which would make it costly for the owner country through cooperation, I think it's a better solution. But of course, this is an idea we are putting out there, and we understand this is very difficult to implement. But at least start discussing, start bringing transparency to these issues.
Terrific. Thank you, Paulo. I think that's a great note to end on. And thanks to you, to John, and your colleagues at the IMF Fiscal Department for putting that idea forward. Thanks to Mary and to Emilio for giving us substantive discussion, engaging with the richness of this report. And thanks to everyone who joined us this morning. Please let people know that this video, as well as the link to the report and the slides from the presenters, will be available on the Peterson website. And of course, the full fiscal monitor is free to download from the IMF website. Thanks very much.